You're listening to Capital Topics, episode number 59. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll review the 2023 market statistics. And next, for our main topic, we will discuss how to measure your portfolio performance. Enjoy! Good morning, James. How are you today?
Good morning, François. I'm well, and a Happy New Year to you.
Thank you. Happy New Year to you as well. So before we start, I'd like to wish our audience a happy, healthy, and prosperous new year. This being said, we have two timely topics to cover today. So with another year passing by, I will start and cover the global capital markets performance for 2023. To help with the discussion, I will be going through our market statistics page, a document you can find on our website Capital Topics in the resources section or directly on our team's page on the PWL Capital website. So after a dismal 2022 when both stock markets and bond markets fell at the same time, most pundit and strategists were pessimistic entering 2023. We now know that 2023 turned out to be another example of how hard it is to make predictions about markets and the economy.
Well, François, yes, it was 2023 did turn out to really be bad news for the pundits who predicted something completely different. So, despite all the warnings at the beginning of the year, 2023 ended out being a very good year, as Frank Sinatra says in his song. A very good year for investors with returns in the double digits for most equity markets globally. Early in the year, the talk was all around inflation and central banks aggressively hiking interest rates to fight it. The fear was that because the central banks, rate increases were historically large, that tightening cycle would push global economies into recession, and that would in turn hamper returns in the stock market and the bond markets.
Yes, and central banks did continue to hike rates in 2023, but at a more moderate pace than in 2022. Here in Canada, the Bank of Canada increased rates on 3 occasions, but by only 25 basis points at a time, from 4.25% to 5%. In the U.S., Federal Reserve increased rates 4 times, but again by increments of only 25 basis points from 4.5 to 5.5. These rate increases did have an impact on inflation since inflation rates were cut in half, here in Canada from 6.3% to 3.1%, and in the U.S. from 6.5% to 3.1% as well. However, the dreaded impact of these rate increases has yet to be felt, particularly in the U.S., where the economy is still expanding and job creation remains strong.
Well, I would add to that, François, that other major central banks also pushed rates higher and were also successful in lowering inflation rates. For example, in the UK, the inflation rate dropped from 11.6% to 5.3%. And in the Eurozone, it went down from 8.6% to 2.9% as a result of the European Central Bank efforts.
Totally, but we're not out of the woods yet on the inflation front, but it's getting much closer to the 2% target aimed by most central banks. In addition to the economic fears related to interest rates increases on the geopolitical side, there was still an uncertainty related to the lingering war between Russia and Ukraine, also tensions in Asia surrounding Taiwan, and later in the year, a war breaking out in the Middle East. So plenty of things to worry about. And let's not forget, on top of that, in March, we were in the middle of a banking crisis with the collapse of the Silicon Valley Bank and Signature Bank in the US, and later in the month, the collapse of the Credit Suisse, a major international bank.
Well, again, needless to say, François, these bank failures caused a lot of turmoil in financial markets when they happened. Most of the gains realized up to then were lost as equity markets sold off, losing between 6 and 7% in a matter of weeks. And again, this was not the end of the wild ride during the year. We even experienced technically a market correction, which is more than 10% down in the U.S. Between July 31st and October 27th, when the market dropped about 10.3%. Other equity markets also sold off, but avoided being in technical correction.
Yeah. And from the lows of October, after that drop, we witnessed a powerful year-end rally in the global stock markets, helped by the central bank putting a pause on their interest rate tightening. In December, the Fed even signaled that no other increases were expected, and that were considering 3 rate cuts in 2024.
Again, this is a great example of why you need to stay invested to capture capital market returns. That short period of 2 months, the end of the year, generated over 60% of the gains in the US and almost 100% of the gains in Canadian equities. The S&P 500, for instance, gained 15.8% in US dollars during that period. The S&P TSX Composite here in Canada gained close to 11.9%. And international developed markets increased by roughly 10% in local currency. So again, if we look at the bond market, it also rallied in those 2 months. Most of the gains with bonds last year occurred in those last 2 months.
Yeah, we never know when a strong rally will occur. So again, don't try to time the market. The strong rally came right after that 10% market correction in the US, and when most investors tend to capitulate.
Exactly right. And this again is a stark reminder to avoid market timing. You want to stay invested. One thing is for sure, 2023 had a lot of ups and downs. It was anything but smooth sailing.
Yeah. With that being said, let's look now at the market statistics as of December 31st. Again, as a reminder, our market statistics can be found on our website, Capital Topics, and in our team section on the PWL Capital website. We'll provide a link for the market stats in the podcast page. So I'll start with fixed income. At the beginning of the year, the prospect of further rate hikes, bond investors were worried that we could see another third year of losses in the bond market, but that fortunately did not materialize. The Canadian short-term bonds were up 5.02% for the year, and the total bond market, which holds longer dated maturities, was up 6.69%. Yield to maturity on these two indices was over 5% for part of the year, but they have now settled in the 4% range.
It's really a relief, François, to see positive returns in the bond market, especially considering the central banks were still in tightening mode, at least in the first half of the year. So with interest rates going up to 5% and more during the year, investors, though, were massively tempted to and put a lot of money here in Canada into GICs and high interest savings accounts.
Yeah, indeed, James. And I can understand that after the miserable returns of 2022, that investors are looking for the stability and safety of these investments to preserve capital. However, word of caution here is warranted. If you are a long-term investor and the bulk of your investments are in GICs and investment savings account, when inflation will stabilizes lower and interest rates fall, the returns on these safe assets will also drop. So this in turn will make it more difficult for you to reach your long-term financial goals.
I completely agree with you on that, François. With these levels of yield on safe assets, it's, at 5% plus, it seemed like a no-brainer to load up. But again, I caution our listeners, returns on equities in 2023 massively outperformed those high interest rates. So the key lesson to remember is to stick to your long-term plan, because the expected returns on equities are higher than fixed income and cash, and that is what will increase your odds of reaching your goals.
Yeah, again, and GICs certainly have their purpose in a well-diversified portfolio, but investment savings accounts, despite their current high interest rates, are poor long-term investments. Over the long term, these cash instruments, because it's investing in cash, should underperform bond and equities as they have in the past.
So talking about equities, François, why don't you tell us how the different equity markets performed last year?
Well, James, it was a very good year with double-digit returns everywhere in the main indices we follow, except for in emerging markets. In Canada, the S&P TSX Composite returned 11.75%. The information technology sector did the heavy lifting with an extraordinary performance of 69.2%, followed by healthcare sector at 18.34%. The financial and industrial sectors also did better than the average of the S&P TSX Composite Index.
So with the information technology sector being the big winner, even though it's a small component of the TSX, I'm guessing that growth stocks outperformed value last year in Canada?
Yeah, you're correct, James. Large and mid-cap growth stocks had a performance of almost 14%, and value stock returned 12.58%. As for the small caps stocks, they underperformed large and mid-cap stocks with a performance of only 6%. This is not entirely surprising, as small cap stocks tend to underperform large cap stocks when there are fears of recessions like we had last year.
So what about U.S. equities, François? What happened in that market?
Well, it was a great year in the U.S. Total market gained close to 26% at 25.96. That's in U.S. dollars. In Canadian dollars, since the Canadian dollar rose against the U.S., performance was a bit lower at 23.26. However, in contrast to last year, large and mid-cap growth stocks dominated value stocks with a spectacular performance of 39.6% versus only 9.1% for value stocks.
Well, again, if François, if I'm correct, the story for U.S. equities last year was the craze surrounding artificial intelligence stocks and other big tech companies. So we all remember the FANG stocks, the acronym. They were replaced with a new term, the Magnificent Seven, a group of high-performing stocks, which are also the seven largest stocks in the S&P 500 by market capitalization. And in that group, you have Alphabet, which is Google, Amazon, Apple, Meta Platforms, which is Facebook. Microsoft, and a new name, NVIDIA, which is new to maybe a lot of listeners, and Tesla. So again, we now have the Magnificent Seven.
Yes, and collectively, these seven stocks make up close to 27% of the entire index. Their performance in 2023 ranged from 48% for Apple to an astonishing 239% for NVIDIA. Their performance, apart from Apple, were more than double the gains of the S&P 500 last year. These seven stocks alone contributed to almost half of the gains of the U.S. market last year.
At some point in the, I think, François, in the first half of 2023, these Magnificent Seven generated all the gain on the U.S. market. But by year end, we could see the gains broadening out into other stocks. Despite that, at the end of the year, 70%, I mean, slightly over, I believe, 70% underperform relative to the index. That's amazing. I presume that like in Canada, though, François, that the information technology sector had the best returns for last year.
Yeah, you're right, James. The information tech sector had a performance of 57.8%, and the communication services sector followed with a performance of 55.8%. I remind our listeners that only 3 of the Magnificent Seven are actually included in the information technology sector. The worst performing sector was utilities with a negative 7.1%. To finish off with the U.S. market, U.S. small cap stocks also had a good performance in 2023 with a performance of 14.4%. That's in Canadian dollar. And similar to the large and mid cap counterparts, small cap growth stocks outperformed value with a performance 16.1% compared to 12.2% for small value. Again, all these numbers are in Canadian dollars. Finally, international developed markets also had a good year. Large and mid-cap stocks returned 16.2%. That's in local currency. In Canadian dollars, returns were very similar at 15.7%. However, as opposed to Canada and the U.S., international large and mid-cap value stocks have outperformed growth stocks with a return of 16.4% compared to 15.1% for growth stocks. Small cap stocks, again, trailed with a performance of 10.7%. To conclude, in the emerging markets, large and mid-cap stocks returned 7.9% with value outperforming growth. And in contrast with other markets, small cap stocks had a very strong performance of 21.8%. All these numbers are in Canadian dollars.
Well, thank you for that very complete summary of what happened in capital markets last year, François. And again, as you highlighted, the market pundits were not forecasting good things for the markets in 2023. And The market surprised everyone and showed resilience in the face of adversity. And as the proverbial saying goes, they climbed a wall of worry.
Totally. All right, now for our main topic, we will tackle how to measure your portfolio performance. This topic goes hand in hand with our first topic. So where do you want to start, James?
Well, François, this topic is near and dear to my heart. As you know, we've been producing performance reports since we started the firm in 1996, and that's been one of our core value add services. The regulator in our industry, however, only came around to making it a regulatory obligation that firms must produce a performance report for clients starting in 2016 with the second phase of the CRM rules.
Wow. That's 20 years later than PWL.
It's incredible, isn't it, François?
Yeah.
What I really want to talk about today, though, for our listeners is how to measure their portfolio performance and, most importantly, understand where their returns come from. And that's really, really important. Why? Because you want to make smart investing decisions and you want to remain disciplined relative to your long-term investment plan.
Yeah, the challenge this year for some listeners will be to deal with the disappointment after they see how strong the numbers are for equities, particularly in the US. As we mentioned earlier, the classic lesson from 2023 is ignore all market forecasts. Markets movements are often dominated by surprises, which of course can't be predicted.
Exactly. And again, as we said earlier, if you go back to January 2023, market pundits were all doom and gloom about the outlook for equities in particular. And the market noise was all about forecasting a recession, which never happened, at least in the US, which is growing vigorously. And now most market pundits are forecasting, quote, a soft landing for the US economy.
As economic forecasts often are wrong, it's unlikely that market strategists will be able to forecast future performance. The lesson for investors is to tune out prediction. Instead, stick to your investment plan, focus on diversification, and rebalance your portfolio when needed.
So, getting back to our topic today of how to measure portfolio performance, my advice for the listeners is you must look at how your portfolio was invested to start the year. Generally, your investment plan it will set out the target allocations between stocks and bonds. So, from there you can measure things.
Yeah, that's pretty basic, but we often speak to new clients and they have no idea what their asset allocation is. And in fact, most of them don't have a long-term investment plan.
Yeah, so for our clients, though, as you well know, François, they all have signed investment policy statements, or IPS in our world, in our jargon. And that, again, has been something we've done since the foundation of the firm. And again, it's part of our value-added service proposition. And this document sets out how accounts will be managed, but specifically it includes the target allocations among asset classes. And so we produce performance reports, and we break out a total return net of fees for the portfolio, and that's aggregated over all the accounts that are covered by that investments policy statement.
Yeah. A typical client IPS covers their personal taxable account, TFSAs, RSPs, or RIFs, and if applicable, their investment holding company's taxable accounts. A performance report gives a total return net of fees. We also generate returns per asset class broken out to show returns for 5 different components: 1 for the bonds, the fixed income, 2 for the other income securities, which we include REITs and utilities in there, 3 for Canadian equities, 4 for US equities, and 5 for international equities, which would include emerging market. This is how our client can see where their total return comes from by being able to see how each asset class has performed.
So for our listeners, I would suggest the next step is to find an appropriate benchmark to measure the performance of each of those asset classes they're invested in. So the CFA Institute, the institute that regulates the chartered financial analysts with their code of ethics and their professional standards, which is a global standard, is well recognized as an industry standard setter. And the CFA Institute believes that a benchmark is essentially the starting point for evaluating investment success. And it is defined specifically as an independent rate of return or hurdle rate, forming an objective test of the effective implementation of an investment strategy.
A bit of jargon here, James, but what this really means is that the benchmark is a measuring tool that must be appropriate for how your portfolio is invested. If your portfolio is invested with a lower allocation to equity, it's normal that your return will be less than someone who has a higher allocation to equity. So both investors have a different benchmark comparison.
Well, that's very well said, and thank you, François, for clarifying that. But again, I'm going to add even some more jargon here.
Right.
And again, going back to the CFA Institute in determining what makes a good benchmark, the CFA Institute believes that one, the most effective benchmarks are the ones that are most representative of the asset classes in your portfolio, and as you said, François, how your actual portfolio is invested. The benchmark must be investable, and by that they mean a viable investment alternative. The benchmark must be constructed in a disciplined and objective manner. Fourthly, the benchmark must be formulated from publicly available information. Fifth, the benchmark must be acceptable as the neutral position. And finally, the benchmark must be consistently.
For our listener, we at PWL, we've done the work for our clients, and we make this information publicly available with our market statistics page that I've referred to earlier.
Yes, and that page really, listeners can take the information and then measure their different asset class buckets. The challenge for most of our listeners is that the firms may not report performance per asset class.
Correct.
So that becomes next to impossible to calculate on your own. So finally, François, I'd like to add the CFA Institute guidelines highlight that choosing a bad or inappropriate benchmark can undermine the effectiveness of an investment strategy and lead to, well, I guess, dissatisfaction or results that are unintended.
Yeah. The overall objective of performance measurement is to evaluate your performance against measurable standards to ensure you meet your long-term goals. Bottom line, if your benchmark is inappropriate, then any interpretation of your performance against the benchmark will result in useless or misleading information, putting you at risk to deviate from your long-term investment plan.
Okay, well, I completely agree with that, François. And you can't compare, example, a classic 60 equity, 40 fixed income portfolio against 100% U.S. equity, or even more obvious, against a concentrated bets in the Magnificent Seven stocks.
Yeah. Another way to measure your performance would be to compare it against the expected returns in the mid-year 2023 PWL Financial Planning Assumptions Guide. If we look at the long-term expected returns for major asset classes, fixed income should deliver 4.19%, Canadian equities at 6.99%, U.S. equities should deliver 6.4%, and international equities, developed and emerging, should deliver 7.35%.
Yeah, so now go back to our market statistics page for 2023, and the appropriate benchmark for these asset classes all significantly outperform compared to those long-term expected returns estimated by the PWL research team. So again, it's as the people who produce wine will say in French, c'est une année de grand cru for this vintage.
Yeah. So James, in your mind, what's the biggest danger of making the wrong interpretation of your portfolio performance?
Well, we talk about it often, François, on our podcast, and it's the same danger every investor faces in January looking back at the previous year, and that's be aware of recency bias. And again, a well-known phenomenon in behavioral economics. Don't invest in something just because it has done well or sell because it has done poorly. Historically, investors tend to buy yesterday's winners after that great performance and sell yesterday's losers after the loss has already been incurred.
Yeah, well said, James. But I also remind our listeners that the markets are a random walk. You can't forecast the future. Unfortunately, past returns don't predict future returns.
And that's why diversification is as important as ever. After the Great Recession, many argued that diversification no longer works because risky assets have become too correlated. However, diversification benefits also come from the dispersion in the range of returns in a group of stocks.
Yeah. Last year, we saw a wide dispersion of returns once again, consistent with the last 20 years, showing that diversification still has strong benefits.
Again, finally, François, I would remind our listeners that active management is a loser's game in bull or bear markets. Last year was another in which the majority of active funds underperform, even though proponents claim active managers outperform in both bull and bear markets.
Yeah, and even in the rare instances when active management does lead to an investor's portfolio outperforming benchmark, it's typically short-lived.
Yeah. Okay. So, François, let's conclude today's main topic. We recommend our listeners stick with their long-term investment plan and that they maintain their investor mindset. As I said last year, there's no way to know where markets may be headed. At this time last year, it was hard to imagine an upturn when prices had fallen so dramatically in 2022. It was hard to imagine an upturn when there was so much uncertainty about the direction of the economy.
And there's always uncertainty in the economy and consequently in the capital markets.
And that's the important lesson. Markets are forward-looking, highlighting how current prices reflect market participants' collective expectations for the future. So history argues for persistence and patience.
A look back at recent history makes the case for sticking with a plan. Our message to our listeners at this time last year in our podcast number 48 was that handsome rebounds often happen after steep declines like in 2022. These rebounds help investors capture the long-term returns the market offers. Those who sold their stock holdings in early 2023 to invest in safe GICs with the allure of much higher rates than what they've seen in over 20 years may have made a mistake. They will have lost out on double-digit equity returns in 2023.
The point is that long-term capital market history is a great anchor to our thinking, François. Again, with a long-term investor mindset. We also remind our listeners that they should have and keep that investor mindset all through the year and continue to buy and hold in investments. And again, that's having the owner's mentality. Stay disciplined and focused on the long term and avoid being deterred by the short-term noise in the financial media.
Yeah, correct. And that is our mantra. So thank you, James, for sharing your thought and expertise today.
My pleasure, François.
So that's it for episode number 59 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in. And please join us for our next episode to be released on February 15th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon.